The NASDAQ is currently closed, but the last reported closing price for Qualcomm Inc. on Monday, October 27, 2025, was $187.68, representing an astonishing intraday gain of plus 11.09% from its previous close. That single-session jump, adding roughly $30 billion to the company's market value, wasn't driven by a standard beat-and-raise earnings report or a major patent settlement. The immediate, unexpected insight here is that this massive move completely tears up the old investor playbook for Qualcomm, which has long been viewed almost solely as a mobile chip maker, forever tied to the cyclicality of smartphone sales and the ongoing licensing disputes, particularly with Apple stock. The expectation for QCOM has always been muted, stable cash flows from its licensing arm, QTL, underwriting a slow, steady pivot in its chip business, QCT, toward automotive and IoT. The reality, delivered with a shock of over 11% in a single day, is that Qualcomm has just declared itself a direct and credible contender in the high-stakes, high-growth AI data center acceleration market, challenging giants like NVIDIA stock and AMD stock. This isn't just about a new product, it's a fundamental re-rating of the company's structural growth ceiling. For a long time, the common ground for talking about Qualcomm centered on its perceived ceiling. The smartphone market is mature, and while 5G and new Snapdragon processors provide a lift, the overall dependency remains a drag. Investors saw Qualcomm as an indirect play on broader tech trends, a solid dividend stock, but never a high-growth momentum pick in the same league as NVIDIA stock or Tesla stock. Its stock movement had for months lagged behind the broader Philadelphia Stock Exchange Semiconductor Index, gaining a respectable but subdued 10% for the year leading up to this recent news, while the index surged 40%. The recent sharp spike, with trading volume absolutely exploding to levels not seen in over a year, indicates a powerful institutional realization that the old Qualcomm is gone. The contrarian take now, the deeper truth that forces a rethink, is that Qualcomm's extensive, often underappreciated history in power-efficient on-device AI, the hexagon neural processing units, NPUs, inside their Snapdragon chips is directly scalable to the data center. They didn't just build a chip, they leveraged a decade of optimization for the hypersensitive power constraints of a smartphone and applied it to a data center facing an energy crisis. That's the tension between expectation, slow mobile pivot, and reality, a sudden credible shot at the multi-trillion-dollar AI infrastructure market. Looking at the recent stock movement, this single-day surge is the primary story. It came on the back of the company unveiling its new AI 200 and AI 250 accelerator chips, specifically targeting the AI inference workload in data centers, which is the process of running pre-trained AI models. They followed this up with an immediate high-profile win, a major partnership with Saudi Arabia's Humane venture to deploy 200 megawatts of Qualcomm's AI rack infrastructure starting in 2026. This isn't a pilot program, this is a large-scale, real-world deployment of their technology, a concrete revenue stream that validates their entry. The daily swing was massive, the volume unprecedented, and the price action suggests a clear break through its previous 52-week high, pushing into a price area where prior resistance levels no longer apply. Institutional activity has been mixed in the run-up to this news. 1,233 institutions increased their stake in the last reported quarter, while 1,301 reduced theirs, indicating a pre-existing debate about the company's future. The announcement settles that debate for many, transforming the perception of QCOM from a value-oriented tech stalwart to a potential high-beta growth stock. However, A crucial piece of internal reality investors need to grapple with is the consistent insider selling over the past 6 months, including from the CEO, which totaled significant sums. While insider selling can often be for personal financial planning, the sheer volume and absence of any buying creates a minor headwind that adds an important layer of skepticism to the overwhelming market excitement. This mixed signal from insiders while the stock surges is a classic expectation versus reality friction point. The market expects growth. Insiders are taking profits. The underlying business model of Qualcomm remains anchored by 2 core segments. The Qualcomm Technology Licensing segment, QTL, is the foundational backbone, which licenses the company's intellectual property, primarily related to CDMA and OFDMA technologies that form the basis of 3G, 4G, and 5G wireless standards. This is the segment that generates extremely high-margin revenue, often called the Qualcomm tax, from virtually every wireless device sold globally, including a substantial portion of the hardware in every Apple stock iPhone. It's a cash flow fortress, providing the stability and capital for R&D. The Qualcomm CDMA Technologies segment, QCT, is the semiconductor business, which designs the Snapdragon chipsets used in smartphones, automotive systems, and IoT devices. For years, QCT was primarily a smartphone story, but under its current leadership, the push into the automotive and Internet of Things IoT segments has accelerated, with the company targeting multi-billion-dollar revenue figures from each by fiscal year 2029. Past performance, while strong, was marred by the cyclical dips in the handset market, which meant that even with solid earnings, the stock was often range-bound, reflecting that dependency. This is where the old reality set the expectation: a good company, but with a constrained growth profile. The recently reported financials, with over $10 billion in quarterly revenue and a strong net margin of nearly 26%, show a financially sound base, a solid platform for the new growth initiatives. This strong balance sheet is what allows them to make a capital-intensive push into the data center. Now, shifting to the future outlook, the AI data center play is the only story that matters for the multiple on Qualcomm stock. The expectation has immediately jumped to Qualcomm becoming a genuine competitor to NVIDIA stock. The reality is more nuanced, but highly encouraging. Qualcomm is focusing on inference, not training, meaning running the AI models, which is the most power-intensive and highest volume part of AI deployment, rather than the initial, more specialized training of the models. This is a brilliant strategic choice because it leverages their core competency, power efficiency. The company is betting their custom chips, based on their low-power NPU architecture, will offer better energy efficiency and lower total cost of ownership for hyperscale cloud providers than the incumbent GPU solutions. This focus on efficiency is exactly what customers like Microsoft, Amazon, and Meta are looking for as they grapple with the exploding energy footprint of their data centers. If Qualcomm can win even a small percentage of this market, its revenue could easily see an incremental lift in the billions of dollars annually by 2027, completely justifying the recent stock re-rating. However, the risks are substantial, and this is where self-investing individuals using platforms like Robinhood or SoFi Invest need to be particularly cautious against getting swept up in the hype. The data center is a brutal market, dominated by the established ecosystems of NVIDIA stock. Customers value reliability, established software support, like CUDA, and a proven supply chain, all areas where Qualcomm is playing catch-up. While their partnership with Saudi Arabia is a massive win, it is their first, and scaling to major Western cloud providers will require significant investment and execution. Furthermore, they're on an annual update cycle for these chips, which puts constant pressure on R&D expenditure. The automotive segment remains a strong high-margin opportunity, with the company's Snapdragon digital chassis becoming a standard for integrated, software-defined vehicles, positioning it well against other competitors. The IoT business, covering everything from industrial robotics to smart home devices, continues to quietly expand. These two segments serve as an important buffer, diversifying the core chip business away from mobile, which is exactly what investors wanted to see before the data center surprise. The future catalyst is the successful commercial deployment and performance of the AI 200 and AI 250 chips, particularly with a major cloud or enterprise customer beyond the initial Saudi deal. A clear and positive update on the deployment timeline and performance metrics will be a critical inflection point for the stock. The main risks include potential delays in the chip roadmap, failure to secure large-scale design wins against NVIDIA stock, or any adverse regulatory